I'm sitting in my office and I get a call from the property manager. It says, Randy, sorry to tell you the building's on fire.
Hello, everybody, and welcome to another episode of Multifamily Chronicles podcast. My guest today is Randy Langenderfer. Randy is the president at InvestArk Properties. Welcome to the show, Randy.
Adrian, thanks so much for letting me be on your show. I really appreciate it, and I look forward to spending some time together.
Randy, I want to start by introducing you to the audience. Tell us a little bit about your professional journey, and especially the part that you are in today, the part of your journey that's related to multifamily and investments.
Thanks. And so my journey started about 10 years ago when I was working for a private equity company. I was in an executive role, and thought I was going to be laid off, not because of any performance issues, just because of the company's financial situation. Adrian, it was really a wake-up call that I needed to do something different. I needed to find another income stream, a passive income stream to support my family. And so I set about a very conscious effort at that time, 10 years ago, to get out of the corporate rat race. And a year ago, I actually exited the corporate rat race and am focusing full-time on multifamily investment. I started out as learning some of it in single-family hard money lending. And I was living at the time in Cleveland, Ohio. I'm currently living in Houston, Texas. And I moved to Houston for business purposes. That job I was speaking of, ended up finding multifamily, fell in love with it, did my first passive investment in 2014, my first general partnership in 2018. End of the day, today I'm a GP in about 1,500 doors, about, 350 million assets under management. And I still passively invest in other people's deals. So I've got, probably 3,000 doors and passive investments as well. I'm all into the multifamily space.
So let's go back to how you actually started to become an investor, to invest in multifamily, and how that evolved. I think that most people that I told to, myself included, just to be honest, I think they're missing, of course, I'm missing a lot, but we're missing, like, how is that initial, how does it start? And then how do you scale, right? Just walk us through it. I want to make this a very educational segment, very practical education.
That's fine. Thanks for slowing me down and taking me back. For me, it was the realization when I was doing single family hard money, as I mentioned, and I was doing it with a brother. I was brother-in-law. I did it. We lived in Cleveland, Ohio, and we invested with this group out of South Florida, Dade County, that was flipping houses. And we made a pretty hefty return. We were satisfied with it. But when I moved to Houston, as I indicated, and I was settling in a new job, family was relocating, and I just found it to be very time-consuming and unscalable. It was very difficult to scale a single family to anything of size without a tremendous amount of work. And so I had attended one of the large multi-family educational seminars and just it was an aha moment for me when I realized I could buy a multi-million-dollar asset easier than I could buy a single family home, because the debt on it in single family is by your income, and the value of it is by the comps in the neighborhood. Well, multifamily is secured by the asset itself and the income it generates. So they're non-recourse loans. And for me, at my season of life, I didn't want to jeopardize what I had accumulated. And so I was very enthralled by that concept. And that's when I really started digging in. I joined one of the large national educational groups. And since then, I've started my own. And I began to really study what it was, multifamily was all about. I love the fact that everybody needs a place to live. They don't always need a strip center or a office building, but they always need a place to live. The changing demographics across the country of becoming a nation of renters. I began to invest passively in other people's deals to learn, because I wanted to get what was good and what was working for other people, as well as what didn't work. And so that's really how I bridged it. And then once you get the fever, it's bad because I was all in. Once you get the fever, then you're looking for deals and you're looking for opportunities, and it mushrooms. You build a network, you start talking to people, you listen to real estate podcasts, and meetups and things like that. It just grows organically.
Randy, what are the things that you're looking at when you're looking at a deal to see if this is a deal that will make sense for you or not make sense?
Especially as you start asking other people to put their money in the deal, that burden becomes very, very real. When I first myself, though, look at as an investor, as a limited partner, first and foremost, who are the general partners? Excuse me. Who are the general partners? What are their investment thesis? And what are their, today, the general partners teams can be pretty large. What are the various roles of each of them? What's their experience? Are they looking at many markets or do they focus on one market? So I always coach my students that I'm sure you do too, Adrian, you get a ton of opportunities come across your desk and they're all going to have the shiny object syndrome saying they 25 or 30% IRR and double your money and et cetera, but they don't even get a second look from me unless I know them already. I may look at them and talk to some of them just to start following them and understand them. But so the first element is the sponsorship group. And then the second element, big element, is obviously the location and the asset itself. What kind of an asset is it? Is it a new Class A build, a 15-year-old Class B build, or a 40-year-old Class C deal? And how much renovation does it need? And how much work does it need? And so none of those are bad. None of those asset classes are bad. I just want to understand the investment story and what it takes today. So that starts anyhow.
What are the classes that you're focusing on mainly? Is it A, B, C type assets?
Yeah, I would say when I talk to brokers, I'm focusing on B plus, B minus assets today. As many people are, they tend to have less deferred maintenance on them, and they still have some value add characteristics to them today. I've also invested in a couple of so a general partner in a couple of Class A's. But when I say that, that's my target, but I'm not afraid to deviate. One of the best investments I made 2 years ago as a general partner came along another partner and we bought a 1969 build in Tucson, Arizona. And that is the strongest performing asset in my portfolio today. Again, I know the sponsor extremely well, my partner very well. We talked and equally minded. I knew his underwriting philosophy. I knew his operational prowessness. It's been a great deal. It's been a great deal.
So how do you vet your partners? How do you choose whom do you want to partner with in a business deal, in an investment deal?
And that's my mentor, Rod Khleif, coins the phrase, partnerships are like a marriage. They're easy to get into, but expensive and painful to get out of. Make sure you choose wisely, just like a marriage. And I think the first element is I really got to have a kind of not a long-standing, but I've got to know the person for a while. And I need to understand, either I've met them at a meetup, a conference, a mastermind, someplace along the way. I'll give you the illustration of my Tucson property. Is I had gone to Phoenix pre-COVID in 20 and 19 on exploratory trips trying to find an asset. And I was told by the brokers and the property managers that you're going to have a really uphill climb because you're not from the market and you don't own in the market today. So that was discouraging. And they tactfully told me you're going to have to overpay in your first couple of deals. And I said, that doesn't sound too good. So when my current partner, who I had met and known for, as I said, a couple of years, we started, I'll call it courting or dancing, looked at the property. I was all in. So what he had, though, that I didn't have is he had the operational expertise in Tucson. This particular partner had only invested in Tucson. So he knew the market up, down, sideways. He had the property management relationships already built that I would have had to develop. Now it's very easy. If I can continue with him, or if I wanted to go into Tucson, I could leverage those relationships today. I could use the same property management company. I could use the same vendors. I know the market today much better than I did 2 years ago. So it's building a relationship, and don't be rushed because there's a deal on the table. There's always going to be more deals coming down the pipeline.
Don't get emotional about this, right? Don't get emotionally involved.
Yeah, I think that sums it up great, Adrian. Don't ever get emotionally attached to the deal or even the friendship. It's a business, and look at it with your analytical mind and determine if it's right for you and your investment thesis. Don't deviate your investment thesis just because there's an opportunity that says there's going to be a 25% IRR in 3 years.
I remember you mentioned the total number of apartment homes that you invested in, but I forgot. I'm sorry. Could you tell again how many apartment homes totally you invested in?
As a passive or as an active or a GP? I'm in approximately 1,500 today. I got another one we're doing right now for another 118 units. So that's 1,600. As a passive, I'm in about 3,000 doors as a passive investor in multiple deals across the Sun Belt and some in Ohio as well.
Are you self-managing or third-party managing?
Always use third-party management. I am not big on, I just don't want the headache of being, I know vertically integrated companies today that are doing that, they're doing it well. It's just not for me. And I think what I do best is not, I do a lot of asset management. Property management is not something I want to focus my attention on.
Fair enough. What's your preference for management companies? Larger shops, smaller shops, somewhere in between, a combination of all of the above?
I think for me, it's a niche in the market we're in. I want to look at somebody that's got experience in that because I'm in Tucson, Arizona, Greenville, South Carolina, Dallas, and Houston. I want a property management company, third-party property management company that's really got experience in that market. And also those are some big areas. So in the sub-market I'm looking at. And then most importantly, again, is that property management has experience, whatever asset class I'm looking at. So if I'm buying a B and somebody's only doing at C-class assets, that's not a non-starter, but it's something that's a yellow flag to look at. Or maybe they're only doing A-class properties and they're coming down to your C-class. It's because they want to do business with you. Again, not a red flag, but a yellow flag of caution and just really understanding it and then, man, you just never know a good property manager until you've had a bad one. And once you've had a bad one, it is so painful an experience that you try to interview the property management company, the regional manager, the on-site. If you're lucky, maybe there's one that's staying from the previous owner. But for the most part, it's like hiring anybody. I did a lot of hiring in corporate America over the years, and it's somewhat of a turkey shoot, but you do the best you can.
Could you walk us through your experience with asset management? You mentioned asset management is one of the things that you do. If you want to include any war stories that you might have.
Asset management, I say, it's what really makes the asset management and property management what makes the deal, right? Because it's always about operations that makes the deal work or doesn't, or implements the business plan. So you really got to have that nailed down. Asset management is just overseeing the property manager. And that entails, in our case, it's a weekly call with the property manager. We're going over key performance indicators. We're checking the maintenance responses. How much is the lag time? We're looking at the lead funnel for leasing. We're talking about rental units that are available and how we're marketing them. We're talking about the time of turnaround to get a room ready to rent again once somebody that moves out. All kinds of key performance indicators that we're looking at over a period of time. And that's time consuming. We also try to visit the property routinely, walk the property so the property manager sees us on site and knows that we're engaged. There's so many owners that are from the other coast, whatever coast you're on, they're from the other coast and they're not engaged. And so to me, it's a key element of it. And a lot of people get caught up in chasing the deal and then don't focus on the operational aspect of it. And that's, again, understanding a general partner's success and what they focus on. As far as horror stories, I was smiling when you said it because the first one that comes to mind is the very first general partnership I was in. Myself and 3 other individuals, Beaumont, Texas, which is about 100 miles due east of Texas, being between Houston and St. Charles for your listening audience. It's a strictly blue collar town. It's heavily petrochemical related. A lot of people, great market, but very blue collar oriented. And we bought this property bought this in 18. It was 139 doors, 1965 chiller, boiler system, flat roof, all the things they tell you not to buy. And 2 months into the property, 2 months, And we ended up losing 28 of the 139 units. And that was a bad day. Ended up turning around, overseeing as a as asset manager, working with the property manager to first and foremost, excuse me, make sure all the tenants are safe. Thankfully, no one was injured in that fire, and all the tenants got out safely. And we then started to rebuild. And so working through that rebuild process is a very detailed, from finding contractors to getting adjusters out there from the insurance company. That's a 9-month process to rebuild 28 doors. And that's not even a big rehab. I ended up turning around though, did phenomenally well in that asset, but it was, I'd say I got my my honorary PhD in asset management.
What helped you keep going, and what contribute? Like, how did you scale? I'm interested in what size was your first asset that you were a general partner in?
Yeah, the first one was that 132 unit in Beaumont, Texas. That was the first one. We owned that for 21 months. I didn't buy again as a general partner until 21. We bought that in 18 and sold it in late 19 or early 20. I didn't buy again until 21. And so really it was, again, looking for those partnership arrangements. I partnered with a group that had looking for assistance. It's a beautiful Class A. It was a 20 build. This was in 21. It was 20 build, and beautiful asset, 396 unit. It was big. And so I joined that group because one, it was in Dallas area, which I love that area from a ownership perspective. It was new, and at the time was very attractive. The second one I did was a long-standing relationship with a group here in Houston that we pulled down. It was a small 60-unit property in here in Houston, in Spring Branch to be specific. And so that was a different group because we had been targeting something to buy for a while. The next one I did was networking. Just through networking, this group in Greenville, South Carolina needed assistance. And so they asked me to join the general partnership team. And due diligence wise, you got to make sure when you're asking other people to put their money in it that you did well. So to South Carolina, I spent a day and a half looking at the property, the comps, reviewing everything about it before I ever decided just to sign on. And then I talked about the Tucson property, how that came about just through a mastermind that I was in with a colleague. And let's see, the one I'm doing right now is a build to rent community in North Dallas. And again, the guy I just lives in my neighborhood here. We knew of each other. We had socialized periodically, coffee, lunch, and he asked me to join. And so I toured the asset, liked the property, and I'm in. So there's not a single way to do it. It just depends on your audience. If they're in a large educational groups or even small ones, there's an opportunity there to partner with people. The large groups, just start to tell people what you want to do, and you'd be surprised at the number of opportunities that arise for you. You just have to be bold enough to ask people what their objectives are and if there's any ability to work together, and be patient. Don't take the first one that comes across your desk.
Randy, I want to focus on the skin in the game part, right? When you scale, of course, you buy a new asset and another one. You had to come up with a financial part, right? You can't just be a partner without investing anything. How were you able to finance? How were you able to source the money in order to scale? Because I think this is the part that it's not being talked about enough. And most people that are trying to get their feet wet in multifamily investment don't really understand. You got the first one. How about the second? How about the third? How did you come up with money? Was it refinancing the first deal? What was it?
No, we didn't do any refinancing, but I think to your point, your listening audience, I've heard it said that the two most important thing a syndicator, somebody that's a general partner, does is they find deals and they find investors. So you're always in the market looking at new deals, and you're always talking to potentially new investors. And there's many different venues to do that. On the capital raise side, I'm a finance CPA, MBA, and so I'm a numbers guy, but asking other people for money is always a challenge. And so you have to start though at some point, and you have to leverage those relationships. And so I spend today I spend a tremendous amount of my time doing that, is just working on the relationships with those investors, as well as looking at new deals. But scaling that, I just think there are many different approaches, and there are many people out there talking about it. But I use the illustration is that I'm fishing myself. I'm fishing with a line, and a single line that I'm casting out each and every day, trying to find one-on-one connections, whether it be LinkedIn, social media, podcasts such as this potentially. But I'm fishing with a line versus some people want to fish with a net and cast a very broad net and do things that way. They're both possibilities. You just have to find which one works for you. Seen many of the people talk about, come learn about capital raising in 5 simple steps, or for money, they want education. But I think for me, it's just old-fashioned relationship building, one-on-one, and getting to know somebody. I don't want them to invest in my latest deal. I want us to have multiple conversations and get to know each other, and me to understand their investment thesis. What are they looking for? Are they looking for a quick return or a yield over a longer period of time? Or I had a conversation with somebody this weekend. I asked them point blank, I said, is your spouse in this? Are they okay with this deal? And because you're going to be talking to them for 3 to 6 years, maybe 7 years, you might as well make sure you start out on a good foot rather than somebody that's got bad premises. I've actually told people I don't think this is good for you. And that is not fun, because you're trying to, but it wasn't. And I think they respected that more than anything in the world. So talk to people, tell them what you're doing, create a scenario of an investment that you've looked at. You don't even have to be yours, but one that and just talk to people. If I could find you an investment like this, that's what I did. Created a pitch deck that just said, if I could find you an investment like this that would return 8% cash on cash, and I could potentially double your money in 5 years, would you at least look at it? Who wouldn't at least look at it that knew you? Great. Can I add you can I put you on my mailing list? I try to send out monthly letters to investors and tell them what I'm doing and what's up. There's not a secret sauce to it. That's what I love about this business. And somebody told me, Adrian, it's just follow the playbook that's in front of you that others have done, and replicate it.
Randy, let's chat a little bit about the current market conditions. What is your big picture look at the current market conditions, and where do you see challenges and opportunities for investors like you?
Yeah, it is a challenging market. One, the large educational arms are pumping out hundreds, if not thousands, of students every year that think they can buy a multifamily with no money down and nothing like that. And it's not that way, as we both know. I guess my forecast is the market. I like what one of my early mentors said. I'm a buyer in healthcare in every market, up, down, and sideways. It's just that you buy very differently. So 2 years ago, if you bought in 2021 or 22, you most likely bought an asset on variable rate debt. There's just one distinguishing factor, and that caused challenges, if not killed some of us. Today, nobody, and I wouldn't buy a deal on variable rate debt unless there's something that I don't know about it. But they're all going back to fixed rate, and where your debt payments are much more defined. And so that's an example of, I bought in the market in 21 when it was variable rate debt, but today I wouldn't. So the market dynamics change and the purchasing changes. And we all know interest rates are way high today. If you listen to all the professionals, it's more around the 30-year norm today than it is really an anomaly, as many discuss, because the 0 and 1 or 2% interest rates that we saw several years ago are no longer viable and not sustainable in the long run. So I think we're going to have to deal with it. I think my personal self, we may see a little bit of interest rate fall in Q3 and Q4, but I don't think we're going to see the 4 or 5 that people predicted rate cuts, and that's going to affect asset values. So buyer beware. There's still deals out there, but you have to be very cautious, I think, today in the market. But I'm still very bullish on multifamily for all the reasons I got into it with. We are becoming more and more a nation of renters. I mentioned this build to rent I'm looking at. What a neat concept. Building a townhome or a home to rent, because people don't want to live in an apartment for their whole lives, but they'll pay a little bit more to live in something like that. Be a student of the market and just study it very carefully and listen to the other gurus and people that are in your network for the future.
There's a lot of chatter about how would you address the affordability issue, the fact that housing gets more and more expensive by the day to rent?
I personally see that's a real plus for us in the multifamily space because I think it continues. I really don't see any macro driver that is going to change that anytime in the near future for affordability to keep coming down, especially in buying a single family home. I'm in the Houston market and it's just crazy growth. Been here 10 years. An average starter home today is $350,000 versus, gosh, a long time ago when I got started, it was a fraction of that. But anyhow, so a single family is expensive and it really takes a dual working income with two good incomes to even consider it. So as I said, I think people are becoming renters by choice for a longer period of time as they try to save a down payment to buy a home. Or maybe they lifestyle wise, they just don't want it. They don't want to own a home in the burb and mow lawns and worry about maintenance and painting roofs and et cetera, et cetera. They want to look in the work and live in the urban core and be able to Uber to someplace quickly. And that's fine too. So I think that the asset class is, because of the affordability, is an attraction to us as an investors. And I don't see rents coming down anytime either in the near future. I studied this market a lot in the Dallas markets, and they were talking about the average number of units coming online in Houston in any given year is around 14,000 units coming new online every year. And those starts are way down in 22 and 23 because they generally have a couple of year lead time to come up. So the prediction is in 25 and 26, there's going to be a further shortage of housing, and more specifically multifamily. You can anticipate rent bumps, if not then before then, but certainly in 25 and 26, because there's going to be a shortage of units. So as an owner, I'm optimistic. As a father of millennial children, it's sad, but they'll be able to do it. They've got good dual incomes, and it's just going to take longer to save. No, it's not positive what people want to hear, but factual.
Randy, could you discuss next the value of coaching and mentorship in your real estate career?
I think that is invaluable to me personally. So Adrian, I started out not knowing. I was attracted to it because I always had an inkling to get into real estate market. I knew I didn't want to be a construction guy and pound nails and move dirt with my hands and stuff like that. I knew that's not the piece of real estate I wanted to be in. So I think I really got into one of the national coaching arms first. And I think mentorship groups are great because they're going to help you eliminate errors. And I know they did for me, as well as propel your growth because they're going to push you forward. And that's whether you want to be a general partner or a limited partner. And so I think there's a tremendous value in that. And I've started my own mentoring recently, and we're offering, I call it the hands-on approach versus the big box, where there are a lot of and I talk to potential students and I say, go out and look at one of the big box, the Jake and Geno's, the Sumrock, the Lifestyles, the Michael Blanc groups. And if it fits for you, great. If you want something that's smaller and more personal, we'd love to talk to you about something much more customizable and much more personable and a whole lot cheaper. But people push back on wanting to spend money on mentorship. And I always say that about myself and many others have invested tens of thousands, if not hundreds of thousands of dollars in their college education or their trade school or wherever they went. So invest in yourself and get some good help to propel your growth and help you define what that growth is. And there's been many of them that have built into my life, and I'm very thankful for it. And I just think that people should consider it if they really want to be active.
When you say invest in yourself, that there's a lot of information, like we're drowning in information nowadays. How do you select great information that you should be exposed to from not so great information when it comes to educating yourself?
The first thing is, I think you have to not listen to everybody. And the social media, the Facebooks and the LinkedIn and stuff has so much information out there that you really need to narrow it down. And I think first for me, when I first started, I would consider myself, I wanted to be an investor versus a speculator. To me, a speculator is somebody who's And my job and my 401k, I put money in a large cap, a small cap, an international fund, a bond fund, whatever. And I just throw money at it and I speculate that that's going to go up. It's not bad, but an investor is one who really studies markets, understands the risk they're getting themselves into, and then makes a buy or no buy decision. So I think the challenge there is to invest in yourself to become an investor. Maybe you're independently wealthy and you don't have to do it, and you can have an investment advisor do it. I still have an investment advisor for my stock portfolio because I don't want to do that. But that investment philosophy, you need to develop one yourself no matter where you're at, whether you're going to. Otherwise, you fall prey to the shiny objects, and then we talked about before on social media or in your email. 25% IRR. It's in Topeka, Kansas, and it's a cryptocurrency or whatever. Myself, I don't understand crypto, and I've never tried to understand it, so I'm not going to look at any of those. I'm not going to look at. I'm focused on multifamily, and I'm focused in a specific area, the Sun Belt region. I'm looking at apartments 100 doors or better, something that I can underwrite and return a nice cash on cash to investors, and hopefully double their money in 5 to 7 years. So that's my investment thesis. But people need to invest in themselves to develop their own. The way you do that is by talking to people and having coaches or mentors help you define that along the way.
As a private multifamily coach, what are some common challenges investors facing, and how do you help them overcome these challenges?
Yeah, I think the biggest one that I see in the students I talk to is it's two things. It's that get rich quick scheme, because there's so much out in the social media, and I'll call it propaganda, about doubling your money and all that stuff. And so there's a lot of people out there that I just want to do a deal. I just want to do a deal. Get me in a deal. No, I think I coach, you need to go slow, go steady. You need to understand what it is you're trying to do. And that back to that investment philosophy versus a speculation. The worst thing I can do is advise somebody just to throw money at a deal because it's available to them, or they found it on LoopNet or Crexy and it's out there. And I just think that's got to go back to the basics of what markets are you focusing on? First of all, why are you doing this? And so we have a 12 module online course that we do. And then we also have group coaching, because I really think group coaching calls every week, because I really think that's the beneficial part of mentoring programs, is to allow people to congregate together and build community and ask questions and leverage off one another while having some oversight from us. And so with us, you get myself and my partner versus a large mentoring box where you're going to have their disciples coaching you. And so that's another differentiation in what people need to decide what they want to do. But I think investing in yourself is really important. You did it for college or trade school or whatever you did. This is attainable, but like anything, you need to follow a blueprint.
Could you share some success stories of people that you have coached, Randy?
Yeah, I haven't been doing it a long time. So those success stories are really more right now around investor stories, where people have used the training to become very educated and looking for investments. And really, you get people, when you start coaching, you get people all across the spectrum. I got a student that's very sophisticated out looking at deals, and I got somebody that I'm not sure can spell multifamily. I mean that jokingly, but so you get them all pieces there. And I think the successes I've had is help people really understand what they want to do. Do they want to be everybody wants to come in and be a buy apartment building, but maybe after a while you help redirect them that you should start being a passive investor first and really come to grips with that and what that means and learn that way. And then others of them celebrating with them when they do take down their first deal. And maybe it's only a 5-plex or a 20-plex, but that's great fulfillment for me in seeing both of those situations come about. I want to help people prevent losing money, and I want to help other people make as much as they want to make or can make.
Randy, thank you so much for taking the time out of your busy day to be here with us, to chat with us. In concluding our conversation, what are some things that you'd like to share with me and with the audience, or maybe answer a question you wish I would have asked and I didn't have the opportunity?
I'm not going to open myself up to any questions I didn't get because but I'm trying to think the offer I would give to your audience out there is on the coaching side if you're considering it. So first, I'd love to chat with anybody in your listening audience if they want to talk about anything real estate. There's two venues you can connect with me. One is on my webpage. I'm on all the social medias, LinkedIn, Facebook. My InvestArk webpage, that's invest-ark.com. There's a contact us page on there. We also, on the coaching side or the mentoring side, I'd like to extend to your audience a one-time opportunity. If they contact me offline, we'll give them a very sweetheart deal. Let them come in and join the group mentoring and see first 3 modules for only $197, just to get them interested in it, to see if they want to do it. But you can do that at .com. That's all one word, multifamilymaestros.com. And we'll make sure that's in the show notes, Adrian, just so your audience, if they have any interest in it, I'd love to chat with them about that too.
Absolutely. Randy, again, it was a pleasure having you today. Thank you very much for stopping by and hanging out with us at Multifamily Chronicles.
The pleasure was mine, Adrian. You have a great day.
Everybody, thank you so much for watching us today. I'm Adrian Danila, your host. This is another episode of Multifamily Chronicles. Hope to see you back here soon. Have an amazing day.